Welcome to the Profit Answer Man, Kyle Smith. It's great to have you join us today.
Super excited to be here, Rocky.
I am too, and I am looking forward to our conversation. Can you tell us a little bit about yourself and your business?
Sure. So I'm a co-founder of Strata Cloud Accountants, and we do accounting up through CFO services. I'm a CPA, but I started my career as a professional poker player, which there's not usually. It's a pretty big swing from professional poker player to CPA.
I don't know. See, I think about that and like, okay, here's a guy who knows how to count cards, right? So it's still, here's a guy who's understanding probability, which, all right, the accountants probably don't spend as much time on probability, but CFO looking at a company is going to look at probability and outcomes and be able to run the math across 6 different scenarios and say that one, right?
Exactly. It's making decisions with numbers, exactly like you said. And that's what I do as a CFO of companies. So when I was playing poker, I realized if it's a zero-sum game, if I win, somebody has to lose. If I lose, somebody has to win. And that started to wear on me, thinking of what I wanted to do the rest of my life. So I decided I'd use my finance degree and work to try to help people on the finance front. So I went back and got my CPA and went to work as a director of finance in various industries, CPG, consumer packaged goods, and hospitality, and then went to work for a company where I was head of the onboarding team. We onboarded 30 to 40 new small businesses a week. And that's where I was first exposed to Profit First and got to see what works and what doesn't across industry. It was a fintech firm, and we were just saw tons of companies. So I got to see all sorts of different business types, ideas, like I said, things that were working well, things that weren't. And me and two partners, they were making software at the company I was working at. Me and two partners were really focused on the service. So that's when we started Strata Cloud, with the idea that we were going to provide the best service to clients, which are small business clients. That was in May of 2020. We took the leap, and we've grown the business ever since.
So why were these companies coming to this company and then you were onboarding so many of them?
Yeah, so it was a company called Scale Factor. They got a big investment, $100 million, I think, in the span of 12 months, to build basically back office AI software that would more or less replace bookkeepers and accountants, was the long-term goal. And so we had a robust sales team and a lot of uh, promises being made. So we had a lot of new clients, but at the time the software wasn't up to where it was certainly replacing people yet. So we, had to do things the way that they had been done, except that we had to move volume of the kind of you'd see like in a software company, a growing software company. And that's why there was so many businesses coming through, which was stressful, but it also gave me kind of a trial by fire because I got to see so many different businesses.
Are they still in business?
No, so they, during COVID, everything got pulled, and we were actually in the process of setting our company up, Strata. We were going to work with them on the software side, but it ended up not working out there. So they kind of split off, but they went away.
Okay. All these companies coming in, what were the biggest issues that you were seeing them experience?
It depended on the industry, but certainly with small business, and at the time, because the idea at the time was growth, 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 no matter what, right? It was the blitz scaling mentality, which certainly is not a bad idea. It's the like Reid Hoffman, LinkedIn, take over the market, and so don't worry as much about profit. I think a lot of other small businesses kind of glommed onto that of, hey, I'll focus on revenue and I'll worry about the rest later. And so we saw a lot of businesses that were not profitable at a unit level. And that's a problem for majority of businesses. Some businesses can survive because they're kind of built to not make money over time, mostly like hyper growth software companies. But most other small businesses, you need to have unit level profitability plan from the beginning. And so that was the biggest thing, is they weren't profitable. That's where we could help a lot, change that, or at least give them the gut check of, hey, here's the things you got to change, or the business is not going to survive because you're not going to have any money.
How receptive were they?
Depending on where they were in the cycle, usually they're very receptive to ways to make more money. That's for sure. And lots of
Ways to
examples
make
there.
more money, but how receptive were they to the fact that what they were doing wasn't profitable?
Yeah, it's tough sometimes, but I think they're receptive once the money runs out, or they're continuing to have to fund or dilute, things like that. They get receptive very quickly. And that's why accounting is so important, because you can show them literally on the numbers, hey, this is how much you're losing. Here's your run rate. Here's when you're going to be out of money. Here's maybe some areas that you need to look at to change. I think that helps a lot because otherwise, yeah, if you're an entrepreneur, you have to put the blinders on a little bit and say, I can do this, even though you might not be where you want to be. So it helps to give them the reality check.
And I understand putting the blinders on and saying, hey, we'll push through and figure out how to sell. I get that. No doubt about it. I struggle with if every sale is unprofitable, if you don't fix that, you're going to sell your way to bankruptcy, right? And so you really have to say, am I profitable at this unit level? And the other thing is for a lot of companies, they might sell 20 different types of units. And so 3 might be profitable, 6 might be break even. The other ones are all losing money. And if you don't know and you're not pushing the 3 that are, you're wasting a lot of time and effort when you could have been successful, but aren't because you've focused on the wrong thing.
Yes, in my career, I've been a part of those type of failures up until what we're working on now, and usually that's the way it goes. Is you kind of have to learn. But I had a mentor that said exactly that. I was working at a brewery, a production brewery, and he was from another big production brewery, had a lot of success, and immediately when he came in, he looked at the numbers and said, "Hey guys, when you add in depreciation, because that's a big part. There's a lot of equipment in breweries. When you add in depreciation, you're making a negative gross profit, meaning they didn't even have enough. They were making they were losing money just on the product cost itself, let alone not including any salaries, rent, all that stuff. They weren't even making money at the gross profit level. And that's to your point of unit level profitability. You have to look at it, and it's not just about, at the time they were one of the bigger breweries in the city, but it doesn't make a difference because if you're so focused on growth and where you are there, you neglect where you are on the unit level profitability, you don't have a business.
And the other problem that I have found is business owners like that are not focused on doing what's best for the client. They're more focused on how do I get my next round of funding, because they know that what they're doing isn't making money. And when you have that mentality, you lose the whole reason you're kind of doing what you're doing.
100%. I think sometimes those folks are really, really good at raising money. They maybe never cared about profitability in the beginning, it seems like, but that's absolutely true. Raising money is its own art, but it has to be, you have to have a plan towards profitability. If you don't, it doesn't matter how good you are at raising the money, it'll go away.
It'll go away. And I think there's a handful of unicorns that made their way through, but it is not the norm. And at the end of the day, you end up with so little of a percentage that it might not be worth the effort. It's funny, there's a book that I was looking for. It's called Stretch, and it's literally about how to be frugal in business. And I think they talk about Yingling, which is a brewer. And while everyone was booming and pushing, Yingling just kept to their basics. And then when these big brewers kind of ended up finding themselves in struggle, they started selling off their big production facilities for pennies on the dollar. Yingling picked up those production facilities, and then that was how they were able to grow profitably and expand quickly over time, slowly, quickly over time.
I'm so passionately in agreement with you on this one because it's that survivorship bias, if you're familiar with that concept. So like the blitz scaling mentality. I'm not I can be in an argument with those folks, but the idea is that you scale as fast as you can so you lead the market and you take over all the market share like LinkedIn did, like Amazon did. There's only one of those companies though. So if you're starting a company, you're betting that you're going to be the one left, and the people that are the ones left are saying this is how you do it. That doesn't make a lot of sense compared to if you're unit level profitable, you can grow over time and you can be adaptable during those downtimes like Yingling was.
Have you ever watched Bezos's movie? Go watch his movie. In the beginning, they're talking about how he's going to sell these books, and he realized that in order to fulfill the books, he had to place a minimum order. Well, if he placed the minimum order, he couldn't afford to buy the book, so he couldn't buy 10 books to sell the one book. And so he figured out a way to fudge the system. So what he would do is he told his guys, go find me books that nobody buys, that are hard to find. So if you wanted to buy the Profit First book, he would go in and he'd order one Profit First book and 9 of these other books. And what would happen is the order would get in and they go, oh, we can't fulfill this, but they'd ship him the one book he needed to fulfill his book, and the rest would get back ordered. And he's like, that's the way, because he thought Literally, if you watch his movie, he thought with the end in mind. How do
Yep.
I build a business in a profitable industry that I can disrupt and change the world? And so he spent so much time thinking about the numbers to build the idea he built, or he wouldn't have done it. And I don't think people realize that part of how to think through the business and do that.
Yep. And he was also at the right time and he knew that too. I bet if,
Yes.
under different circumstances, he might have built the business a completely different way. And that's the point. I'm certainly not doubting the genius of Jeff Bezos at all, but there was amount of luck and the amount of recognizing where he was as a company and what they needed to do that isn't the answer for every company. And in fact, it's not the answer for 99 companies out of 100, probably.
It is not the answer for nine. First of all, you have to have his thinking process and his way, and you have to have timing, right? You have to be the right time with the right place with the right idea. And for most business owners, I don't think they don't have thinking time. They're doing, they're not actually running the math. Going back to your poker, right? Probability of the next card, probability of an outcome, you do the math, and then that's how you bet. Is this win, lose? You don't risk it all, figure it out. And so it kind of all fits together nicely there. One of the things you talk about is holding businesses accountable to their company level goals. Why is that something to focus on?
I think it's super critical because with small and medium-sized business owners, even executive teams, they have goals that usually, like you said, you're in it and you're doing it. So you set these goals and they might be arbitrary. So we've worked with somebody that said, I want to grow, I want to grow the business by 50% next year. Does that make sense with the amount of time that's required? This would be my first question: does that make sense with the amount of time that's required from you, and are you willing to put in that time? Because maybe you're working 40 hours a week now to grow the business by 50%. Maybe you need to, and you have these cost goals, right? But you want to grow the business, but you're not going to add any sales help. You're not, so there's not really it's a nice number, but there's no roadmap to get there. So that's what we do is, does that align with your goals? And so that they maybe say, I want to spend the same amount of time in the business. Okay, then we're going to need to plan for a team, and we're going to need to see how that team affects profitability and see if we're still on board and still see if that's still feasible and makes sense. So that's why it's starting with, does this make sense for you personally a lot of the time, and then going forward and seeing if that goal really makes sense for the business.
And so we're just at this time of the year, we're finishing up all of our forecasting for next year. If a business owner came to me and said, I want to grow 50% next year, my first question, or the first thing I would look at is, well, 24 versus 23. You were flat, you grew 8%, you lost business. Where is the trajectory that shows me you're going to grow 50% next year? Explain to me, what are you going to do differently to make that happen? Does the company have capacity to deliver? And going back to what we were talking about before with cash flow, do you have the money you need for growth? Because growth takes cash unless you're smart enough to build a model that doesn't require cash for growth. And there are ways to do that. Do you have the cash to cover the growth? And if you don't, then setting a goal like that, A, might blow you up. B, if you don't have systems, processes, and scalability already built in, then the first question is, how are we going to build that and operationalize it for you to meet this? Because otherwise you're going to upset the customers you do have. And now we're going to go backward. And yeah, you really do have to plan it all out.
Absolutely. And what you said of avoiding implosion, you could grow 50%, and part of that is selling, right? And so say you succeed on the selling front, are you ready to deliver? If you don't, you'll implode incredibly quickly. I've seen it happen. And like you said, and when you're going to grow 50%, a lot of the time now you or your sales team might be stretching a little bit on what you're delivering for clients. So you have to be super clear that there's not a big gap between what you're selling and what you're delivering. That's super critical. And two, I was going to agree 100% on the underestimation of cash flow. I think I've heard the saying or whatever it is that you need X cash that you think you do for growth. So if you think you mean this much, multiply it by 2. I'll not tooting our own horn here, but for CFOs, in general and having a good finance team. That's why it's so important to have a good finance team, because we can get down month by month on growth and show you here's how much cash is in the bank, and based on your plans, here's what it's going to take. So we can get a lot closer than just doubling what you think it's going to be. But long story short, it takes more than you think it's going to take to grow every time.
And you're absolutely correct. And that's why we look at things like, can your suppliers deliver? How are you going to ramp up people and when? How are you going to get through those steps? And then what's your billing and receivables look like? Because if you start selling 50% growth on 90 days payable, you're going to implode just from the fact that you've got so much money out there that none of it's coming back. And if you can't keep the cash cycle and the cash return cycle going, that alone, even if you hit your goals and you do everything else perfectly, that alone will crush you. And so you got to have the financing or the cash in place to be able to do that.
That's a great point. And getting a line of credit, I think, is a huge one there. Just, I mean, not to get too specific, but that's banks and other lending institutions, they only want to give you money when you don't need it. When you need it, that you can have it, but it's going to be really expensive. And you get behind on receivables and then you're looking for cash. That's when you start getting into the 30, 40% weekly payback type loans that then start stretching you even further. And then you start getting way behind, and then you're stuck, and you've got a profitable business model that's working, but the cash isn't working, like you said. That's such a huge point. If every business owner knew the importance of receivables and keeping them under control and being able to forecast, a lot more businesses would survive, because there's a lot of winning businesses that go under because they can't collect.
They can't collect? That's horrible. You can't sell stuff to people that won't pay you.
I know.
And so part of that is even knowing enough to do credit checks on the people you're doing business with. If you're going to become hey, banks do credit checks. If you're going to loan this guy money to buy your stuff, you should be doing credit checks if it's of a significant, issue to keep track of that. And then they start factoring their receivables, which again takes the profit. And so that's the thing. If we're going to factor receivables, we better price for it.
Exactly.
Now, in order to get the 50% growth, they start discounting 15%, and then they start offering terms, and now the whole model blows up.
%. Yeah, two quick examples. I worked with a client that their model was they got paid right after the service was performed every time. That was the model, and they switched to a consulting model where everything was on credit. So we had to plan in the future, because that consulting model was much more profitable, but now we have a receivables build that could be coming, and then we budgeted for it. So we knew that we'd be okay, because we were very conservative on here's what we think we're going to collect on. It was basically, we estimated like a 45-day cycle. So we could plan ahead and get ahead of that, and they got a line of credit in that case, so we could draw on it and overcome that growth period and make sure we were watching the receivables every week. That was their point of focus, to keep it under control. Planning is so important, like you said. And second example was working with a CPG company that they made a healthy profit of like 15%, but they wanted to go into growth mode, and they did that exact thing. They worked with a big wholesaler that started kind of nickel and diming into that gross profit, to where that 15% went away. Now all of a sudden their revenue is 50% bigger or whatever it was, but they're a break-even company now instead of profitable. It's so hard to think about those things, but you have to before you make those big decisions.
So as we think about this, what are the most important things that we should be tracking, and how do we track them to boost profitability?
Yeah, so first, I love the gross profit, and I'm not a gross profit expert. I'm not a profit first expert, but I do subscribe to the model, and I think it's a great way for small businesses to hold themselves accountable, like we were talking about earlier. So I think that's a great base. If you're looking at a profit and loss statement, it's how do you get that pie bigger? So I think for us, looking at gross profit is huge. If you're talking about unit level profitability, if your gross profit is basically your direct costs, your revenue minus your direct cost. And if you're not tracking that number every month, that's really costly, because like you said, if you've got 5 or 10 different things that you're selling, and your gross profit goes from 35% down to 30%, and you're already making 10% at the bottom line, there's half your profits gone. So you definitely need to be watching that and watching why, and finding out why, because the percentage is really, really important. Also, you can do things like, hey, we know we're going to take a cut on gross profit, but it's going to mean more dollars in terms of the percentage, and we're willing to do that. So you're not surprised at the end of the month if your gross profit percentage goes down, but you've got more dollars. it's really important to look at gross profit. That's a huge one. And then the other big one that we say for business owners is look at the difference between net income and net cash. And that goes back to exactly what we talked about before with receivables. If you look at, because most people don't look at a cash flow statement or know how to use it. Even accountants I know don't know how to look at a cash flow statement. You can ignore everything on a cash flow statement. Just go down to that bottom net cash number and compare that to your net income number. If there's a big difference, if your net income's positive and your net cash flow is negative, you've got to find out why. And a lot of times you brought up the point of receivables. If you're not collecting, you're going to show a positive net income number potentially, but you're going to show negative cash because you're not getting paid. So those are the two big ones. Look at gross profit, look at the difference between net income and net cash, so then you can make sure that you're actually getting profit. Your profit's actually cash coming into the business, then you can continue to grow.
And I think those businesses that are going through growth, the other thing that they have to deal with is inventory. And so they're like, where's my cash? It's on your shelf. It's in inventory. And they
100%.
don't realize that that's where it is. And so if you've got to grow your inventory to grow your sales, now people aren't paying you and it's sitting in the warehouse. And so that kind of will give you trouble as well. And so you've got to be aware of that as well, managing it. And then the third thing is, if you grow and you grow fast, you make mistakes. Especially if it doesn't matter what you're doing, your product at points might get, whatever kind of business you're in, right? You might have to redo something, or it gets damaged because you're all hustling. All of that wastage doesn't show up in the P&L, right? It just shrinks away. And if you can't see it and you don't have a good way to measure it, then all of a sudden that's what happens. Or you start doing things differently in order to deliver for this growth, right? Smaller package sizes, more complicated offerings, all of that stuff, if it's not systematized and ready, starts sucking up more cash.
Yep. No, and I at least love to go through a cash flow statement with my clients one by one, line by line, and we'll see those things. Especially if we have a plan, we can measure against the plan. So like you said, if you're planning for those changes that you just said around your product, let's see what we expect it to do in cash, and then let's measure if it actually happens. But that's a huge one, inventory. So a lot of times on the cash flow statement, we'll see a huge negative number for inventory. And what that means is they spent a bunch and their inventory got really big from one month to the next. And that can be a big explanation of, hey, why is our cash not where it needs to be?
And unless you've got systems and processes, because let's face it, most small businesses probably not tracking inventory.
I hope they start.
Well, and so if you're not tracking inventory, you have no idea what the change was, because you have no idea what you even have. And then the other problem with that is you might have what we call the other half of shrinkage is it walks out your back door, employee theft or whatever. And so if you got no way to track that, that's a whole nother problem.
Yeah. And the thing that you said, if you're not tracking inventory, what I said about gross profit is moot now. Because that number, if you don't have an inventory, if you run a substantial inventory and it varies from month to month, your gross profit number is not going to be accurate if you're not taking inventory, because you could have gotten a big order at the end of the month, and that's going to make your gross profit number go down because you're showing a lot more cost. But that cost is sitting on the shelf. It's not an actual cost yet. So it's really important to take inventory for all of those reasons, because you're flying blind if you don't.
When all those businesses came to you, when you were there, what percentage of them do you think were flying blind?
Definitely the majority, because that was the company was set to help small businesses. So folks that have it totally nailed down on the financial side are usually not going to be coming to that business and saying, hey, everything's perfect, but we want to give you guys some money to fix it anyways. It's mostly businesses that were struggling. So I'd say I didn't see any. It was very rare that we saw a business that was like really buttoned up in terms of their finance and their back office processes.
And so that's just a warning that if you don't button those things up, there's a good chance you're going to get yourself in trouble. And it's a lot easier to button them up at the front than try and fix them at the end.
Yeah. And on the positive side, if you button them up, you have a big advantage on other companies that aren't doing it. If the vast majority aren't, and you start early, you can make those decisions more nimbly. Because like you said, you're going to make mistakes no matter what. It's the companies that make the mistakes that then can pivot very quickly that win over time. It's not some magical formula. It's how fast they can change. Jeff Bezos is the king of that, being adaptable.
And that is very true. Is there something else we should have talked about that I didn't get to ask you about?
You stayed ahead of every big passionate item that I have. You so I think that's because we both work with small businesses, and see those pain points. But no, I'd love for folks to start measuring. That's the thing I would say. So most people put their hands when it comes to measuring financials because they're like, hey, I'm not an accountant. I don't even know where to start. Just start 30 minutes a month looking at your numbers. If you don't have numbers, start bookkeeping or get someone to do it because you can do it very reasonably. But look at your numbers. If you're using Profit First, that helps do it for you. That's another big advantage. But look at your numbers, and then those will start bringing up questions. And then you can go find the answers. But it doesn't take a lot just to bring those questions up. And so don't throw up your hands, get overwhelmed. Look at your numbers at least monthly, and then see if you can start making changes.
And that's the key. And that's our goal, is to help you, understand you're not alone. Because I think the vast majority of businesses have all of these issues. It's actually the minority that do things correctly. So you're not alone. And now the question is, do you want to fix it? And if you don't know how, find help.
100%.
If people would like to learn more about what you do and how you guys do it, what's the best way for them to find you?
Sure. So our website is Strata, STRATA, stratacloudaccountants.com. And we have a special landing page for your listeners, Rocky. It's stratacloudaccountants.com/Pam, which Profit Answer Man. But we have free downloadable tools to help you start measuring.
Cool. And I will make sure we add that to the show notes. Thank you so much for joining us today.
It was awesome to chat.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.